Welcome back to Boni's Life, where we turn market chaos into trading clarity and transform technical analysis into actionable profits. I'm Boni, and if you're new here, you've just stumbled into the most comprehensive crypto trading analysis on YouTube. Hit that subscribe button because today we're diving deep into the next 24 hours of crypto markets. Today's episode is what I call the Trading Surgeon's Toolkit. We're going to dissect the past 24 hours with surgical precision, identify the exact technical triggers that matter for your next trades, and hand you a complete playbook for the next 24 hours. We've got Bitcoin flirting with psychological levels that would make a therapist blush, Ethereum breaking through resistance like it's made of tissue paper, and institutional money flowing in faster than coffee at a trading desk on Monday morning. But here's what makes today special. We're not just talking about what happened, we're talking about what happens next. I've got specific entry points, exact stop losses, and profit targets that are so precise, you'll think I've got a crystal ball. Let's dive in. Let's start with where we are right now, because in trading, context is everything. Bitcoin is currently trading at $107,770, down 0.84% in the past 24 hours, which might look like a red day on the surface, but experienced traders know that sometimes the most profitable setups come disguised as minor pullbacks. Here's what's fascinating about Bitcoin's current position. We're sitting just above the critical $107,000 support level, which isn't just a random number on a chart. This level represents the convergence of multiple technical factors. It's where the 50-day exponential moving average meets significant volume clusters, and it's the level that's been tested 3 times in the past 2 weeks without breaking. In technical analysis, we call this a triple-tested support, and when it holds, it often becomes a launching pad for the next major move higher. Ethereum is painting an even more compelling picture at $2,761, up 0.28% and showing signs of what technical analysts call relative strength. While Bitcoin is consolidating, Ethereum is actually gaining ground, which historically has been a precursor to broader market strength. The RSI on Ethereum is sitting at 66.84, which puts it in that sweet spot where momentum is building, but we're not yet in overbought territory. But here's where it gets really interesting. The overall technical summary across major cryptocurrencies is showing 14 buy signals versus only 3 sell signals. That's not just bullish. That's what we call broad-based technical strength. When you see this kind of alignment across multiple time frames and multiple assets, it's usually telling you that the market is setting up for something significant. The moving averages are particularly telling a story that every trader needs to understand. We're seeing 13 buy signals from moving averages versus just 1 sell signal. This isn't just a coincidence. It's the market's way of telling us that the underlying trend remains intact despite short-term volatility. When price action sits above the majority of its moving averages, it creates what we call a technical tailwind that can accelerate moves in both directions. Now let's get into the technical meat and potatoes that will determine your trading success over the next 24 hours. I'm going to break this down into time frames because different time frames tell different stories and successful traders know how to read all of them. Starting with Bitcoin on the daily chart, we're looking at what appears to be a bullish pennant formation. For those new to technical analysis, a pennant is like a flag on a pole. It represents a brief consolidation after a strong move, and it usually resolves in the direction of the previous trend. The measured move from this pennant pattern gives us a target of $115,000. which aligns perfectly with other technical projections we're seeing from institutional analysts. But here's where it gets really interesting. The volume profile during this consolidation has been decreasing, which is exactly what you want to see in a healthy pennant formation. Decreasing volume during consolidation followed by increasing volume on the breakout is one of the most reliable patterns in technical analysis. We're currently in that decreasing volume phase, which means we're likely approaching the apex of this pattern. On the 4-hour chart, Bitcoin's RSI has reset to around 50, which is significant because it means we've worked off the overbought conditions from the previous rally without breaking the underlying uptrend structure. This is what professional traders call healthy consolidation. The price takes a breather while the indicators reset, creating the foundation for the next leg higher. Ethereum's technical picture is even more compelling. The break above $2,800 wasn't just a psychological victory. It was a technical breakthrough that cleared multiple resistance levels simultaneously. We broke through the 2,700, 2,740, and 2,760 supply zones in one decisive move, which is what we call resistance cluster penetration. When multiple resistance levels get taken out in a single move, it often leads to accelerated price action as stop losses get triggered and momentum builds. The path ahead for Ethereum looks remarkably clear from a technical perspective. According to on-chain analysis, there are only 200,000 to 400,000 ETH in supply levels between the current price and $3,400. That's an unusually thin resistance profile, which means that if buying pressure continues, we could see rapid price appreciation with minimal overhead supply to slow it down. Here's a technical trigger that every trader should have on their radar. If Bitcoin can close a 4-hour candle above $110,000 with volume exceeding $2 billion, it would confirm the pennant breakout and likely trigger algorithmic buying from institutional players. This isn't speculation. This is based on observable patterns in how institutional algorithms respond to technical breakouts with volume confirmation. Now let's get to what you really came here for, specific actionable trading strategies for the next 24 hours. I'm going to give you 3 different approaches depending on your risk tolerance and trading style because one size definitely doesn't fit all in crypto trading. Strategy number 1 is what I call the scalper's paradise. This is for traders who want to capture quick moves and aren't afraid of being glued to their screens. For Bitcoin, you're looking for entries between 108,500 and 109,000 on any pullbacks to the 20-period exponential moving average on the 15-minute chart. Your target is the $110,000 resistance level, which gives you a risk-reward ratio of approximately 2 to 1 if you set your stop loss at $107,500. The key trigger here is volume. You want to see at least a 20% increase in 15-minute volume to confirm the move. For Ethereum scalpers, the setup is even more attractive. Any retest of the 2,750 to 2,800 range represents a high probability long entry, with targets at 2,850 and 2,900. The beauty of this setup is that you're buying into what was previously resistance that should now act as support. Your stop loss goes at $2,700, which gives you a tight risk profile with significant upside potential. Strategy number 2 is the swing trader's dream. This is for traders who prefer to hold positions for several days and capture larger moves. The Bitcoin setup here is particularly compelling. Any close above $110,000 on the daily chart triggers a swing long position with targets at $115,000 and potentially $120,000. Your stop loss sits at $106,500, which is below the key support cluster we identified earlier. The Ethereum swing setup is even more exciting. A confirmed break above $2,850 with daily volume exceeding the 20-day average sets up a swing trade targeting $3,153 and potentially $3,400. The risk reward on this trade is exceptional because you're riding the momentum of a major resistance breakout with clear technical targets ahead. Strategy number 3 is what I call the Breakout Hunters Special. This strategy is designed to capture explosive moves when key technical levels get decisively broken. For Bitcoin, you're setting a buy stop order at $110,500. That's $500 above the key resistance level. If this level gets taken out with conviction, you're immediately positioned for the momentum move that typically follows major breakouts. Your initial target is $113,000, with a trailing stop that locks in profits as the move develops. For Ethereum breakout hunters, the setup is a buy stop at $2,880, targeting the psychological $3,000 level. The beauty of breakout trading is that you're only in the trade if the setup is working, which means you avoid the frustration of sitting in sideways consolidation. But here's the crucial part that separates professional traders from amateurs: risk management. Regardless of which strategy you choose, never risk more than 2% of your trading capital on any single trade. I don't care how confident you are in the setup, the market can humble anyone. And capital preservation is the foundation of long-term trading success. Now let's talk about what the smartest money in the room is thinking, because understanding institutional perspective can give you a significant edge in your trading decisions. The past 24 hours have delivered some remarkable insights from the people who move markets with their decisions. Michael Saylor, who's essentially become the institutional voice of Bitcoin adoption, made some statements that every trader needs to understand. His assertion that Bitcoin is going to $1 million isn't just hopeful thinking. It's based on supply and demand mathematics that are becoming increasingly compelling. Saylor points out that only 450 Bitcoin become available daily through mining, worth approximately $50 million at current prices. When institutional demand exceeds this $50 million threshold, which is happening more frequently, basic economics tells us that price has to move higher. But here's what makes Saylor's analysis particularly relevant for short-term traders. His observation that winter is not coming back suggests that the institutional adoption cycle has reached a point of no return. This means that major pullbacks are likely to be viewed as buying opportunities rather than reasons to panic, which creates a different risk profile for traders. When institutions view dips as accumulation opportunities, it puts a floor under the market that didn't exist in previous cycles. Bitwise Asset Management has provided perhaps the most sophisticated analysis of Bitcoin's current valuation. Their quantitative models estimate Bitcoin's fair value at around $230,000 based on current sovereign debt probabilities and macroeconomic conditions. This isn't just a price prediction, it's a mathematical assessment of Bitcoin's value as a hedge against fiscal instability. For traders, this suggests that current prices around $107,000 represent a significant discount to fair value, which provides a fundamental backdrop for bullish positioning. The institutional flow data is equally compelling. BlackRock's Bitcoin ETF saw $336.7 million in inflows on June 10th alone, with total Bitcoin ETF inflows reaching $431.2 million that day. These aren't retail investors making emotional decisions. These are institutional allocations based on rigorous analysis and long-term strategic thinking. When you see this kind of sustained institutional demand, it creates what we call structural support for prices. Ethereum's institutional story is equally impressive. BlackRock's Ethereum ETF has maintained a 17-day consecutive inflow streak, accumulating nearly $5 billion in total inflows. This makes it the leading spot Ethereum ETF in 2025, and the sustained demand suggests that institutions view Ethereum's current price levels as attractive entry points. Here's a perspective that every trader should consider. Cathie Wood's ARK Invest maintains their $1 million Bitcoin target within 5 years, based on Bitcoin's finite supply and growing adoption as a global store of value. While this might seem like a long-term consideration, it actually has immediate implications for trading. When respected institutional investors have targets that are 10 times higher than current prices, it suggests that any significant pullbacks should be viewed as opportunities rather than threats. The regulatory environment is also providing tailwinds that traders need to understand. The U.S. Senate's passage of the Genius Act by a 68-30 vote represents bipartisan support for cryptocurrency infrastructure. This isn't just political theater. It's the foundation for increased institutional adoption and regulatory clarity that removes uncertainty from the market. The macroeconomic environment over the past 24 hours has created a perfect storm of conditions that favor cryptocurrency adoption and price appreciation. Understanding these global events isn't just academic, it's essential for positioning your trades correctly in the current environment. The most significant development has been the US Consumer Price Index data, which came in at 2.4% year over year, below the expected 2.5%. The core CPI was even more encouraging at 2.8% versus the expected 2.9%. This might seem like small differences, but in the world of institutional trading, these deviations from expectations can trigger massive capital flows. The immediate result was a drop in the US dollar index to 98.5, its lowest level in months, which creates a favorable environment for risk assets like cryptocurrencies. Here's why this matters for your trading over the next 24 hours. When the dollar weakens, it typically leads to increased demand for alternative stores of value. Bitcoin has increasingly been viewed as digital gold by institutional investors, which means dollar weakness often translates directly into Bitcoin strength. The correlation isn't perfect, but it's strong enough that traders should factor dollar movements into their cryptocurrency positioning. The international developments are equally significant for market dynamics. Ukraine's introduction of Draft Bill 13,356, which would allow the National Bank of Ukraine to include cryptocurrencies like Bitcoin in the country's national reserves, represents a continuation of the nation-state adoption trend. While Ukraine might not be the largest economy, the precedent of sovereign Bitcoin adoption creates legitimacy that influences institutional decision-making globally. The stablecoin legislation progress in the U.S. Senate is particularly important for Ethereum traders. The Genius Act's passage creates regulatory clarity for stablecoin operations. And since the majority of stablecoin activity occurs on the Ethereum network, this regulatory clarity directly benefits Ethereum's fundamental value proposition. When regulations become clearer, institutional adoption typically accelerates, which creates sustained demand pressure. From a trading perspective, these global events create what we call fundamental tailwinds that support bullish positioning. When macroeconomic conditions, regulatory developments, and institutional adoption trends all align in the same direction, it creates an environment where technical breakouts are more likely to be sustained and pullbacks are more likely to be shallow. The Federal Reserve's policy implications from the CPI data are particularly relevant for cryptocurrency traders. Markets are now pricing in a higher probability of rate cuts later this year, which reduces the opportunity cost of holding non-yielding assets like Bitcoin. When interest rates are low or falling, investors are more willing to allocate capital to assets that offer appreciation potential rather than income, which structurally benefits cryptocurrencies. Now let's talk about the part of trading that separates professionals from gamblers: risk management. I don't care how good your technical analysis is or how compelling the fundamental backdrop might be. Without proper risk management, you're just one bad trade away from significant losses. The first principle of risk management in cryptocurrency trading is position sizing. The general rule is never risk more than 2% of your total trading capital on any single trade. This might seem conservative, especially when you're looking at setups that seem like sure things. But remember that the market's job is to humble overconfident traders. If you're trading with $10,000, your maximum risk per trade should be $200. If you're trading with $100,000, your maximum risk per trade should be $2,000. But position sizing isn't just about the total amount you're willing to risk. It's also about how you structure that risk across different types of trades. For scalping strategies with tight stops, you might be comfortable risking the full 2% because your time exposure is limited. For swing trades that you'll hold for several days, you might want to reduce your risk to 1% or 1.5% because longer holding periods expose you to more potential market moving events. Stop loss placement is an art that combines technical analysis with risk management principles. Your stop loss should be placed at a level where, if hit, it invalidates your trading thesis. For the Bitcoin scalping strategy we discussed, the stop at $107,500 makes sense because a break below this level would suggest that the support cluster we identified isn't holding. For swing trades, your stops should be placed below significant technical levels that would indicate a change in the overall trend structure. Here's a risk management technique that many traders overlook: correlation risk. When you're trading multiple cryptocurrencies simultaneously, you need to understand that they often move together, especially during periods of high volatility. If you have long positions in both Bitcoin and Ethereum, you're not really diversifying your risk. You're doubling down on the same directional bet. Consider this when sizing your positions across different assets. The concept of heat is crucial for active traders. Heat refers to the total amount of capital you have at risk across all your open positions. Even if each individual position only risks 2% of your capital, having 5 positions open simultaneously means you have 10% of your capital at risk. During periods of high market volatility, this heat can quickly turn against you if correlations increase and all your positions move in the same direction. Profit-taking strategies are just as important as stop-loss strategies. The Bitcoin swing trade targeting $115,000 should have a plan for taking partial profits along the way. Consider taking 50% of your position off at $112,000, which is the previous all-time high. This locks in profits while still allowing you to participate in further upside. The remaining 50% can ride with a trailing stop that protects your gains while giving the trade room to develop. Let me give you the exact trading setups that I'll be watching over the next 24 hours, complete with entry points, stop losses, and profit targets. These aren't suggestions. These are the actual trades that professional traders will be executing based on the technical and fundamental analysis we've covered. Bitcoin setup. Number 1. The breakout play. Entry trigger is a 4-hour candle close above $110,000 with volume exceeding $2 billion. Your entry is at $110,100 immediately after the breakout confirmation. Target 1 is $112,000, which is the previous all-time high and represents a natural profit-taking level. Target 2 is $115,000, which is the measured move from the pennant pattern. Your stop loss is at $108,500, which gives you a risk-reward ratio of approximately 1 to 3 on the full move to target 2. Bitcoin setup. Number 2, the retracement buy. If Bitcoin pulls back to test the 108,000 to 108,500 support zone, this represents a high probability long entry. Your entry is anywhere in this zone with a tight stop at $107,200. Target 1 is $110,000 and target 2 is $112,000. This setup offers a better risk-reward ratio than the breakout play, but it requires patience and the discipline to wait for the pullback. Ethereum setup. Number 1. The momentum continuation. Entry trigger is a break above $2,850 with daily volume exceeding the 20-day average. Your entry is at $2,855 with target 1 at $2,950 and target 2 at $3,100. Stop loss is at $2,750, which is below the previous resistance that should now act as support. This setup capitalizes on the momentum from Ethereum's recent breakout above $2,800. Ethereum setup number 2, the support retest. If Ethereum pulls back to retest the 2,750 to 2,800 zone, this offers an excellent risk-reward entry. Your entry is anywhere in this zone, with a stop at $2,700. Target 1 is $2,900 and target 2 is $3,000. The beauty of this setup is that you're buying into what was previously resistance that should now provide support. For altcoin traders, Hyperliquid presents an interesting breakout opportunity. The symmetrical triangle breakout above $42.25 sets up a momentum play targeting $46.50 and potentially $50. Entry is at $42.50 with a stop at $40. This gives you a 2-to-1 risk-reward ratio to the first target and 3.75-to-1 to the second target. Chainlink's descending channel breakout offers another compelling setup. Entry above $15 targets $18 and potentially $20. Stop loss at $13.20 protects against a false breakout. This setup benefits from both technical momentum and the fundamental strength in the Oracle sector. Here's the crucial part. These setups are only valid if the broader market conditions remain supportive. If Bitcoin breaks below $107,000 or if we see a significant reversal in the macroeconomic factors we discussed, these individual setups become much less reliable. Always consider the broader market context when executing specific trades. As we wrap up today's comprehensive trading analysis, let me synthesize everything we've covered into a clear roadmap for the next 24 hours. The technical picture across major cryptocurrencies is showing broad-based strength, with 14 buy signals versus only 3 sell signals. The institutional flow data shows sustained demand from sophisticated investors, And the macroeconomic environment is providing tailwinds through a dollar weakness and improving regulatory clarity. Bitcoin's position just above the critical